Picture this, it's 2021 and you keep hearing about this Chinese tech giant. Exploding growth, dominating e-commerce, cloud, and fintech, the whole package. People are even calling it the Amazon of China. The stock looks cheap, the growth looks unstoppable, and everyone keeps saying that it's a no-brainer. So like any curious investor, I dig in. I do my research, I read the reports, and I convince myself. Yes, this is it. I start buying. Now fast forward to today, 2025, it's one of my biggest positions and it hasn't moved an inch. In fact, it's the most expensive deadweight in my entire portfolio. So was I completely wrong about Alibaba? Honestly, kind of. But here is the twist, I am not selling. In this video, I am going to walk you through why I bought Alibaba, what I got completely wrong, and why, despite all that, I'm still holding my position. Whether you've held a losing stock or you're just curious how value investors deal with disappointment, this one's for you. So let's rewind a bit. Why did I even buy Alibaba in the first place? First of all, what got me really excited was their growth. Between 2014 and 2021, Alibaba's revenue was growing at an insane pace. It grew over 45% per year on average. And that is not just fast, that is turbocharged. Then there was their cloud business. In 2020 alone, it grew more than 60% year over year. At this point, people weren't just calling Alibaba the Amazon of China. They were saying things like it's Amazon plus AWS, but on steroids. But here's where it got really interesting for a value investor like me. In 2021, Amazon was trading at a PE ratio of around 60. Alibaba at around 25. So let me break that down. You have a business growing faster than Amazon, operating in a country with the fastest growing middle class on the planet, dominating e-commerce, cloud, logistics, and more, and you could buy it for less than half of the price? I mean, come on, what's not to love? It looked like the perfect deal. Growth like a tech rocket, priced like a beaten-up industrial. I did the numbers, read the reports, nodded confidently at the screen, and hit buy. This, I thought, is how fortunes are made. But then the reality hit. And it turns out high growth and low valuations doesn't always mean you found the next Amazon. Which brings me to the painful part. What went wrong? Oh, and by the way, do you know what never goes wrong? It's clicking the like and subscribe buttons. Trust me, they work. I have tested them myself. So all jokes aside, not long ago, Alibaba was the poster child of China's explosive growth. A tech giant scaling at a speed higher than the nation's booming economy. In 2020, right in the thick of the pandemic, Alibaba posted a jaw-dropping 40% year-over-year revenue growth. And it felt unstoppable. But those high growth days are now in the rearview mirror. By 2021, growth had already cooled to just under 19%. That's still strong, but it's a clear step down. Fast forward to today, and Alibaba's revenue is growing at less than 10% a year. So what happened? Well, it's not just Alibaba's problem. It's China's problem as well. The country's post-COVID recovery was sluggish. The housing crisis is still unraveling, youth unemployment is high, and consumer confidence is shaky. People are spending less, and for a platform that is built on transactions, that is a serious drag. But there's also political layer to the story. In late 2020, Jack Ma publicly criticized China's financial regulators, and then disappeared from the public eye for months. Shortly after, Beijing launched a sweeping crackdown on the Chinese tech sector. Ant Group's IPO was abruptly pulled, and Alibaba was hit with a $2.8 million antitrust fine. That moment kinda marked the end of the company's booming growth era, and the start of a much tighter leash from the government. Then there's the Alibaba Cloud, once hailed as the company's next big growth engine. After years of booming expansion, cloud growth had stumbled. While the last 2 quarters showed some signs of life, growing 13% and 18%, they followed a string of quarters where growth slowed drastically, sometimes even dropping into the low single digits. The glory days of massive cloud momentum? they're gone for now. Part of the slowdown comes from tough competition, with Huawei and Tencent fiercely defending their turf. Additionally, there's the 2023 corporate restructuring, where Alibaba split itself into multiple units. It also may have distracted the leadership and slowed down innovation. Now, faced with these headwinds, Alibaba is changing course. It's dialing back on the bold bets and focusing on efficiency, profitability, and global expansion. Core businesses like Taobao are back in the spotlight, while flashier ventures are taking the backseat. It's a more cautious and mature playbook, but also a sign that Alibaba's days of runaway growth are likely behind. A lot of investors have given up on Alibaba, and honestly, I understand why. The past few years have been tough. Slowing growth, regulatory pressure, and the weaker Chinese economy has scared many investors away. But I am not selling, and I want to walk you through why. To do that, we'll first take a close look at Alibaba's financials. So Alibaba is currently trading at around $108, and I'm pretty sure it's trading at around $114 before market open. Despite all of that, as you can see, the company is down quite a lot from its all-time highs of over 300. Looking at their financials, what stands out here is their PE ratio. They're currently trading at around 15 PE, and their forward PE is just under 12. They have a decent 10.9% return on invested capital, and their net debt is negative, which means that they have more cash on hand than debt. So far, everything looks amazing. Now, looking at their revenue, we see this massive growth until year 2021, then a small dip in 2022, and continued growth over the last 2 years. However, this growth is much slower than the one we saw a few years ago. As far as their net income goes, we also see this huge growth until 2021, then an even bigger drop, and continued growth afterwards. Now, this is what I love about the company. Until year 2021, they were issuing shares basically every year. And as soon as the company's price dropped, and the company became cheaper, they started buying back shares, buying back around 15% of the company over the last 4 years. Now let's look what the analysts are predicting for the company. So as you can see, analysts predict the company's revenue to continue growing over the next few years. The pace is maybe not that big, as it's growing at around 6 to 8%. However, that is still growth. So after digging through the financials, here's what stands out to me. Alibaba has no debt, which is a huge plus in an uncertain macro environment. Also, it still maintains a solid return on invested capital, showing it knows how to use its money well. And because all the fear is priced in, the stock is trading at low multiples. No, the company isn't growing at the same pace it once was, but it is still growing, and in this market, that matters. Now that we've looked at the financials, let's talk valuation. If I'm holding on to this stock, I need to know that the price I paid or the price today makes sense based on the company's long-term potential. So let's run my intrinsic value calculator to find out what is the company worth today. In the last 12 trading months, Alibaba did $7.38 in EPS. And analysts predict the company will grow at around 6 to 8% annually over the next 5 years. So let's give them a 7. And let's say for the 5 years after that, the company's growth will slow down and they will only manage to grow at around 5% annually. I think we can keep the terminal multiple at 15, and as you can see, with all of these assumptions, to get an annual return of 10% for the next decade, you would need to pay $134 today, which is quite a bit lower from its current price of $108. In fact, I've adjusted the numbers and it seems like the company's returns for the next decade would be closer to 13% if you would buy at the current price. Now keep in mind, these numbers do not include share buybacks, which they are doing fairly heavily. So I would say we could increase these two numbers by 1% just to account for the share buybacks. After these adjustments, it seems like the company could still return around a 14% annualized return for the next decade. So here's the bottom line. I believe Alibaba has stabilized. The relationship with Chinese government seems less tense than it was during the crackdown. Jack Ma is no longer missing. leadership changes have settled in, and the company is once again focused on its core business. On top of that, cloud growth is turning around, and Alibaba is becoming a more efficient, disciplined version of itself. So even if it doesn't go back to the growth levels we saw in 2020, I still expect 12 to 15% annual returns over the next decade, based on the company's today's price and fundamentals. In my opinion, that is not hype, that's just value. And that is exactly why I'm still holding on to the company. Following Alibaba has been a roller coaster. When I first bought the stock, it looked like a complete no-brainer. A dominant player in e-commerce, cloud, logistics, you name it. It was the China's Amazon and then some. But what I didn't understand back then was just how much government policy, political risk, and sentiment can affect the business, even one with strong fundamentals. Over the past few years, I have watched Alibaba's stock price fall, I watched headlines scare people away, I've seen growth slow down, restructuring take place, and confidence disappear. And despite all that, I'm still holding. Why? Because when the dust settles, what remains is still a profitable, efficient, and cash-rich company, now trading at prices that reflect pessimism and not reality. Alibaba may never be the explosive growth engine it once was, but slower growing, cheaper Alibaba is still a compelling investment in my opinion, especially for long-term investors who think about decades and not news cycles. This journey reminded me that value investing isn't about timing headlines. It's all about recognizing mispriced quality. And at least for now, I still believe Alibaba fits that description. That's why I bought it, that's why I held it through the chaos, and that's why I'm still holding. Now, if you're curious about other undervalued investments, I recently released a video choosing my 3 undervalued stocks for July. It might be a good watch if you're looking for new investment opportunities. You should be able to see it somewhere on the screen. If you enjoyed the video, consider subscribing and clicking the like button. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.